Does waiting for a lower interest rate actually save you any money? I'm hearing this often. Clients are saying to me things like, we want to wait for the market to cool off and interest rates to come down just a little bit. But today I'm going to walk you through a scenario that explains exactly why waiting may not be a good idea. Let's say that you're interested in purchasing a $400,000 home today. And for the sake of simple math, we're going to pretend that we're putting 20% down on this $400,000 purchase price. This means we're financing $320,000 and putting $80,000 down. Again, 20% down is not a requirement, so I always like to stress that, but we're just using it for the sake of simple math, and the principles will apply regardless of what your down payment is. Based on current market rate of 7.375, that's going to put the principal and interest portion of your payment at $2,211, right? By contrast, let's say that you decide you want to wait a year, and let's pretend that we know what the market's going to do and that in 12 months from now, interest rates are at 5.5%. But the problem is that a year from now, that exact same house that cost $400,000 to buy today, a year from now is likely to cost something more like $460,000. So now your 20% down payment, instead of being $80,000, is $92,000, and now you have to finance $368,000 instead of $320,000. So the monthly principal and interest payment at 5.5% interest on a $368,000 loan is $2,019. So you've roughly saved $192 a month by waiting. Sounds smart, right? Except what you have to consider is that you initially had to come up with $92,000 for down payment instead of $80,000, and you financed $368,000. So let's back up to the original scenario where you buy the house today at $400,000, and let's pretend again that we know interest rates come down to 5.5% in a year from now. What you could do is refinance that mortgage a year from now, right? So now you've got a loan with a $320,000 balance that you're refinancing 1 year after you bought it into a 5.5% interest rate. So now, because we're financing a much lower amount because the house costs less, that 5.5% rate payment is actually going to be $1,817 a month, right? So again, let's compare the two. If you bought the house in current market at $400,000, you financed it for 1 year at 7.375 and paid the $2,211 a month. Then refinance the mortgage in 12 months to the 5.5% interest rate with a monthly payment of $1,817. Comparatively speaking, if you wait a year for the 5.5% interest rate and pay the $460 for the house instead of the $400, over the life of 30 years at that $2,019 payment, then you will have repaid $726,840. When you add the $92,000 20% down payment, the total cost of that house would be $818,840. But if you bought now, you would pay the $2,211 for 12 months plus $1,817 for another 30 years afterwards, which adds up to a combined total of $680,692. I'm even going to add in $6,000 to cover the cost of refinancing, and then of course we want to add back in the $80,000 down payment that you had up front. The total cost of the house by purchasing it now goes down to $766,692. So you've saved $52,000 by purchasing today instead of waiting. One other important thing to keep in mind, remember that in a market where interest rates are lower, there's more competition, right? More buyers are in the market searching for houses, which means any potential seller is more likely to get multiple offers. This means they don't have to do things like make repairs. They will likely get over asking price for the property. They might not cover things that are customarily paid by the seller, like title insurance. So you're going to get a much better deal purchasing a home in a market where interest rates are higher, and you can always refinance the mortgage. If you have any questions, reach out. I'm always happy to help.